Alright guys, you see the title of the video. Here we're going to be reacting to the ICT 2022 Mentorship Episode 2, taking it way back. Seems like a long time ago, even though it's only been about, 2 years. Getting nostalgic here. For a lot of guys, this was may have been the very first trading video they ever watched. Maybe this even introduced them to trading in and of itself. Lots of hype around this 2022 mentorship. Me personally, obviously, all my members and I know that I've been studying within the ICT private mentorship since early 2019. But this absolutely was a groundbreaking mentorship just because it, kind of brought a lot of elements of Price and his teachings together, kind of just meshed it together into one simple model that works very effectively with the proper psychology and risk management. So yeah, I think this is definitely worth coming to look back on, and that's why I'm here reacting to it. So let's just get straight into it. I'm starting right here at 12:46 on the minute, just because this is technically when the teaching really starts. You guys know he likes to ramble on and whatnot, but anyway, let's just get straight into it. So let's go.
Futures March delivery contract, and this is a TradingView chart. If you've never used TradingView.com,
love TradingView.
The way you would pull this symbol up is NQH2022. Okay, and this is a weekly chart. And I want you to think about each week before the new trading week begins, preferably on the weekend. Okay, the idea is you want to try to get a read on what you think that next weekly candle is going to do. Is it going to go higher or is it going to go lower? You're not trying to...
That right there is very important, and I'm so glad he brought this to my attention early on in my learning curve, which is the very first level of your analysis should be on this weekly time frame here, okay? Just looking at that before we even open up, or maybe just when we open up on Sunday, just take a look at that weekly candle and just, look at the probabilities of, are we more likely to trade higher or lower based on, do we have a liquidity pool below us, like right here? Have we already taken liquidity? What's the seasonal tendency? What's the current underlying market structure? Where are the inefficiencies? That type of thing, to be able to determine where are we more likely to go with that weekly candle. That's where we start. And then we go down to the daily, and then you guys know the rest. So let's keep it going here.
Predict the close of the weekly candle. That's important, okay? You just want to see, before this weekly candle opened up, all we had was this indecisive candle, okay? Do you think that this candle that would have formed and opened here is more likely to go higher or lower? Obviously, with the benefit of hindsight here, but I can tell you, all of my students know we've been looking for lower prices. And I'll just give you a quick short list as the reasons why. Number one, seasonality.
Small, indecisive candles a lot of times can lead to very volatile, large weekly candles. Keep that in mind.
Okay, seasonal tendencies, it tends to go down around this time anyway. We also have discussions about how the Fed's going to raise interest rates. The stock market does not like that. We're also in earnings season. There's a lot of volatility because of earnings, and those factors, plus the underlying tone of the marketplace, which I'll show you when we get into the daily chart, it's heavy, and this is where it was going to draw to, okay? Did I expect this entire range to be delivered in 1 week? No, that's not important. The point is I'm expecting the weekly candle to expand on the lower end, okay, or go down and gravitate towards this low, which it hasn't broken yet, but I think that's what we're probably going to aim for on Sunday's opening going into Monday's trading. So that's where I think it's drawing to. And that's the component I want you to focus on with your analysis. What is the market likely to draw to? When I say draw to, think of it as price being a paper clip, okay? And then you have this magnetic impulse that specific price levels and seasonality, okay, will put on price. It'll cause price to gravitate towards certain levels.
Great analogy.
And the measure of speed and magnitude that it moves to get to these levels, you learn that over experience. That's not something
experience is the biggest teacher that you'll ever have.
You have to practice and see and study, and you get a rhythm for it, okay? Every educator knows what I mean by that, and every student that's been trained successfully by any other educator will not understand exactly what I mean by that. You just get a feel for it. It's experience. There's no way of defining outside of that. In the early stages of your development, you want to at least try to focus your attention on where that weekly candle is going to do. Now, here's the thing. It may start the first half of the week, or maybe just one day, expand lower. And if you get it set up in that, that's it. You're done. That's how you start working towards consistency. No student ever should try to trade every single session, every single day, because the only thing you're doing is building an expectation that you're going to be able to do this every single day profitably.
Exactly.
And then if you do get a run of profitability, as soon as you get a losing trade, it's going to blow your mind, and you're going to want to correct it quickly.
I always say this, guys. Can't stress it enough. Newer traders that first get into trading, going on that initial lucky winning streak is far worse and does the most damage as opposed to going in and taking losses. In fact, taking losses in the beginning, typically, if you keep pushing to the failures and whatnot, leads to a higher chance of you succeeding. Now, a lot of the times when traders start right off the bat with profits and they get that lucky first run up, does a lot of damage, and I can go on all day about that, so I'm not going to do that. So let's get right back into it.
Start making irrational decisions, and then you enter that loser cycle I've talked about many times in the YouTube channel. So the only thing you're looking for is a likely movement higher or lower based on the weekly candle. Okay, that's all you're doing. That sets your initial bias for the week. On the daily chart, you're looking for swing highs and swing lows to get your liquidity, and majority of your trading and the draw on liquidity, what makes the market go higher or lower, it's predominantly found on this time frame. Okay, so majority of your analysis should really be linked to this time frame right here. You have to have an assumption whether you're going to be expecting that weekly candle to expand higher or lower. That's your weekly bias. But then you have to go into the daily chart and figure out basically where you are in the grand scheme of things on that weekly range expanding higher or lower. Because we're looking for lower prices and we're looking for weakness.
If you're trading in tune with the likelihood, so let's say the likelihood you determine is bullish for the weekly candle. If that's the case, you want to be using the most leverage on longs, and then if you're going to take shorts, intra-week, which is fine, you want to use the lowest leverage because you're going against what that weekly candle is likely to do.
Expectation is we want to see every short-term low, like this would be a short-term low, this would be a short-term low, and underneath those lows is going to be sell stops. Okay, that's liquidity. When I say learn to start looking for where the market's going to draw to, it's drawing to one of two things. Okay, it's drawing to stops, which is liquidity, or it's running to an imbalance. Now, what's that mean?
Very powerful statement there.
Above old highs, buy stops. Below old lows, sell stops. Imbalances is something like this over here, where you have one single candle pass higher, and the previous candle's high is here, and the next candle's low is here. So it only went up one candle, nothing moved down to overlap with that same delivery on that price candle there. So in other words, that's an imbalance. It's only going higher and nothing else is here to offset that and efficiently deliver price on the opposite end. Now, you probably heard of the theory, auction theory, okay? And folks hear me try to communicate some of these things and they'll run away with, oh, he's just talking about auction theory. And it's not. Just like when they see me do a rectangle.
I've never heard of auction theory.
You'll see one in this video. It's not supply and demand. Okay, it's just
no sir.
What it is. You'll see it, and
no
you'll know
supply
right
and
away
demand.
after you've been with me for a couple weeks that this is entirely unique and there's nothing else like it. And I'm certain the majority of you are going to fall in love with this model. So we're looking for lower prices. We're looking for an expansion. I'm using the benefit of hindsight, but I can promise you again.
I fell in love with the model at first, Michael, but I think I have a different model now that I love even more. But yeah, you were right.
This was discussed. We were looking for lower prices in my paid group. And if I did not say that, I have a lot of students that are making YouTube channels. They are welcome to come out and say I'm a liar.
He said a paid group? Paid? I'm just kidding.
So we're looking at the daily chart. We're going to drop down into the hourly chart. Okay, now what I have here is a framework for looking at the weekly range.
This has grown to become my very most, I don't know where I was going with that, but anyway, the hourly time frame has grown to become my favorite time frame over the years. It's definitely my favorite now. So
Hourly chart. So all I did was beginning on midnight New York time, Monday's candle, and then Friday's close, and then the beginning of Friday's trading at midnight. Okay. Now, what I'm delineating here is the fact that we had a nice sell-off on Thursday, and the market went into consolidation overnight. Notice what happens here on Friday. This is that old low in the daily chart. That's what we're thinking, and we're assuming that it's going to draw to, because that daily chart, there's lots of liquidity. And large fund traders, large institutional traders, institutional mindset investors will be looking at these old lows and old highs. And liquidity providers will be looking to take business in around these same levels. So if we know that this level down here is the old daily low, and again, let me take it back up to the chart on the daily chart. That's this low right here. Okay?
yes, sir, we got it.
By dropping down into the hourly chart, that level is here. All I'm doing is transposing those daily levels right to this hourly chart.
Daily levels are king.
The entire week has been bearish. Okay, it's been going lower since the beginning.
Yes.
Then we had consolidation in here. The market creates this short-term high and this short-term low. What
Engineered
rests above that
liquidity.
short-term high? If you've taken notes and been paying attention, it's buy stops. What's resting below this low here? Sell stops. Watch closely. The market trades down initially and takes out the sell stops. Why would it do that first?
Induce shorts.
This is inducing shorts, okay? So it engineers liquidity. Even if the idea is that they want to take the market down to this level, if it's been consolidating, I like to see them do this type of move here, where it drops down first. It's kind of like a sucker play. Anybody that has a sell stop below here, they want to sell on weakness, they're going to get tripped into the marketplace. So now,
Before I let him continue on here, this is just very powerful. I mean, literally in the very first episode, he just gave some very valuable information. So, I mean, just look at the chart here. The entire week has been trading since Sunday, trading lower towards that old low. What's everyone going to want to keep doing? Shorting. It's pretty obvious by the time we get to Friday that we're going to, we're bearish, okay? It's pretty obvious to the open public. Everyone's going to want to be shorting. So what are they going to want to do whenever everyone has a good idea of, okay, I want to short? They're going to engineer liquidity like this. They drive it down there, so everyone's going to want to short off of that breakout, right? And so what do? They dip it down there, come right back up. Where's their stop loss going to be? It's going to be right above this engineered high here, chasing this breakout, right? So they're going to short once it goes below here, aiming for the lows, and then put their stop above here. And this is where the sucker play comes in, and this is classic market manipulation. They drive it down and do shorts, boom, drive it up to their buy stops, accumulate those buy stops to then distribute them lower towards the intended target, which is that daily low.
triggered in short. And then they start doing a run against those traders and against those that were already short from this high.
Exactly.
So what are they doing? The market's being driven higher, and the algorithm's going to attack that buy stop liquidity pool. Why would they want to do that? Number one, it's going to punish those individuals here that went short.
Okay.
When it drives above this high here, it sends all those buy stops.
Floods the market with
into
orders.
Market orders, flooding the marketplace.
Yep.
That gives a huge influx of willing buyers at a high price, which is the perfect counterparty to smart money that wants to sell at a high price. Remember, the market wants to go down here. So when it drives up to here, those buy stops are the counterparty or the other side of a smart money trader that's wanting to go short, because they're going to sell short. They got to sell it to somebody who wants to buy at a high price. That's why the market does this, okay? In your notes, you want to record anytime a significant price move lower is expected, always anticipate some measure of a stop hunt on buy stops or a short-term high being taken out. Obviously, it's
already in my
reversed when
notes,
you're
Michael.
looking for higher prices. Generally, you'll see a short-term low taken out and sell stops taken before you see a very pronounced rally higher. Don't take my word for it. Go through to your charts and you'll see it's actually occurring almost on a daily basis. So we're going to drop down into a 15-minute time frame. So that same old low level down here, and that high I just mentioned on the hourly chart and the low on the hourly chart has now been defined with a small little line segment. Okay, so we have a trend line here and a trend line here. That's the extent of a trend line. That's it. I only use them to highlight to my students. These levels are not on my chart.
Nope.
I'm watching a naked chart. Okay.
Honestly, whenever you said that, whenever I first heard that, I was like, oh man, I want to do that too. I want to have a naked chart. I want to get to that level where I don't have to have anything plotted on my chart. 4 years in, I'm still putting all this stuff on my chart. I don't know. I need it. It helps me, so.
While you're developing, you should have these levels drawn out on your chart because it helps you build and ingrain the idea that this is where liquidity is. It keeps you focused on that because it's easy to look at all these candles forming if you have the luxury of watching it in live, and you can lose sight of where you are. And once you lose your bearings, it's really confusing. And this helps you keep those bearings in mind. And what do I mean by that? Well, I mentioned how the market dropped down initially, and that takes the sell stops out. So sell side liquidity has been attacked. Traders are now tripped in going short if they sold on a break, trying to be a breakout artist. And then the algorithms go right back up to an area where it's been cleanly delivered relative equal highs. See how this high here, right before it dropped, is basically the same high here. Notice that?
Engineered.
So retail traders see this and they trust it as what? Resistance. So the books always say, put your buy stop, if you're going to go short, right above a clear level of resistance. Well, these levels work for a short period of time, but majority of the time, you see this event right here. And this is how I teach my students to go in there and look for those types of events, because what did I just tell you moments ago about looking for significant price moves? Before there's a significant price move of any real magnitude or importance, generally there's going to be a stop hunt that takes place right before that price delivery occurs. So what does it look like?
99.2% of the time, if there's not a stop rate, I'm not taking a trade.
You have relative equal highs, this high and this high. The market goes up when we're what? We're expecting lower prices on that weekly chart. We're on the last day of the week. It's already been heavy. It's weak. And the only thing it's been doing is consolidate. And the first thing it did was broke out to the downside, tripping what? Traders in a breakout to go short. So now they have traders caught on the wrong side, offside, and now they want to take the market up here, where those buy stops are going to be resting for those that were smart enough to sell short here or here and didn't get out below here. So
I just remember my first time watching this video and just like oh, wow, like that's really what's going on, man. Why didn't he condense all this stuff in one video with the private mentorship? Damn, dude. Man, that was that paradigm shift.
Here, because it's in sync with the downtrend, and everybody that was short the day before, they seen this high form, and once it broke below this low here, they all rushed and trailed their stop loss right above that.
And they got their asses handed to them.
I understand if you're new and you think, well, this is easy to explain in hindsight, but I want to remind you, go back and look at the first slide I showed you. Those were actual entries. That's a live account through Thinkorswim. Charles Schwab, that was the clearing firm that did the brokers side of the business.
Yes, sir.
Okay?
Good work.
So I'm not showing you a demo account. I'm not showing you paper trading. Those were real entries. Okay, they were real reversals, the whole business. But the main thing was I showed you that larger trade.
No.
This is going to be the framework that I'm teaching you how to find it. Okay, but this pool of liquidity, once this occurs, you want to drop down to your lower time frames and start looking for something specific. And let's go into those lower time frames and find out what that is.
When I remember that sentence like it was yesterday. He said, let's go down to the lower time frames. You want to be looking for something specific. Let's go down to the lower time frames and figure out what that is. I was like, whoa, what is it? And this was like the most exciting part of the video for me, I remember. So let's watch it.
Here's a 2-minute chart. Why a 2-minute chart? Well, 2 minute, 1 minute, or 3 minute, or 5. 5 minutes still has a lot of room for imbalances to occur underneath that time frame. And what do I mean by that? The 1 minute, 2 minute, 3 minute chart tends to be the best for finding the imbalances for indices. Okay, don't take my word for that. Okay, if you're looking for,
in my opinion, especially with imbalances, the best entries come from the 5 minute and the 1 minute. So that's just my personal, thing. I just think the 5 minute and 1 minute offers the best setups with order blocks and fair value gaps.
Frequency setups intraday, the 1, 2, or 3 minute chart are just beautiful. They just offer a real good clarity. The reason why, because the high frequency trading algorithms are operating on nothing really higher than 3 minutes. But majority of the time, they're like seconds. Okay, 15 second, 30 second, 45 second, 60 second intervals. Okay, and what they're looking for are these small little imbalances. And what does that look like? Well, we had that run on the buy stops here. Okay, remember that old high here, the old high here, old high here. It runs right on through that. Once this occurs on that higher time frame, 15-minute time frame, you want to drop down to the lower time frames. And I'm using the 2-minute chart because this is exactly what I was using to find that imbalance and trade off of it. Okay. The market creates a short-term low here, and then it breaks below that. This is key. This is called a break in market structure. Now, the foundation of the underlying framework is we're in a market that's what? Weekly bearish. We are expecting that weekly candle to expand lower. It's been expanding all week. So we have momentum on our side. We have a consolidation that's occurred, and we had a pool liquidity engineered with these relative equal highs, and the market broke out to the downside first, and then they ran on the highs. So once it went here, we don't rush in there, just go short because it went above the old highs. We're looking for some specific signature that tips its hand to you, okay? And I promise you, when you start going through your charts, and it's going to be homework for you, you're going to see this occurring almost every single day. And if it's not doing it this way, it's doing it the opposite direction as a buy.
It occurs every single day. However, this model right here, the shift in market structure, return to an imbalance on the lower time frame like this has created a lot of liquidity because a lot of guys are trading this every single time without higher time frame narrative, knowledge of the current market conditions, underlying market structure. They're not in sync with higher time frame institutional order flow, that type of thing, and they get tripped up, and this scenario fails a lot of times.
Okay.
If you don't know what you're doing, and that's enough said on that.
Again, don't take my word for it. You're going to be flabbergasted. You like that? Flabbergasted when you see how many times this thing forms every single week. Okay? It's many times throughout the intraday charts it creates this type of move. But when you see how many times this thing forms every single, and then it breaks below it. So now we have a break in market structure. Okay? Once this low is broken, you're going to look for this little area here. That's that imbalance I mentioned in the beginning, right? So what's happening is the market's going to go right up inside that area there.
Like a paintbrush.
That's where you want to sell. Now, if you don't sell there, you can drop down to a lower time frame, 1 minute chart. If this was a 3-minute chart, you can go down to a 1 minute chart and look for that to occur on that time frame as well. And it many times will form if you're looking at a lower time frame, like say this was a 5-minute chart, and you looked at a 1 minute chart, you'd find one down in here. It's a matter of scaling down in your time frames, because once you have an underlying premise to the market now likely to go lower, it becomes an easy thing to look for these types of things. So in your chart, once you're developing this idea and learning it, you're going to highlight this candle's low, this candle's high, and this right here is what I teach my students as a fair value gap. Okay, you don't have those.
My favorite PD
you
array.
don't have any of that kind of stuff out there. It's something I introduced.
Nope. Eli Brooks came out with the fair value gap first, not you. No, I'm just kidding, guys. He absolutely is the author of the fair value gap. A lot of guys on Twitter were saying that, but anyway, let's get back into it.
2016, and obviously a lot of people have discovered how good it is, and they try to make courses with it, but I'm going to not touch that right here. But the idea is once it go up into that imbalance there, and once it does that, as soon as it enters that area, The algorithm that delivers price. Now, some of you may not know what that
Algorithm.
means, and some of you may not even agree with it. You may think that this is made up or it's contrived. I promise you, if you spend time with this, you're going to quickly come to the conclusion that there absolutely is an algorithm, and it's manipulating the markets every single day, every single tick. It's completely controlled, okay, period. You're led to believe it's buying and selling pressure. Now, if I go back and use that analogy where it went down here first, then go up.
If it was buying and selling pressure and the markets weren't controlled and they weren't manipulated, I wouldn't be profitable, okay? The only reason why I can accurately predict what the markets are going to do every single day with my private group, my inner circle members, the only reason why I'm able to even, have that degree of precision is because they are controlled and manipulated, and I look for their footsteps, and that's where we execute.
Here, some of you may argue, see, that's the buying and selling pressure. No, it's not. It's liquidity. Now, you may argue and say, well, we're arguing semantics. No, I'm telling you what's going on. This is the logic. This is how these markets book, okay? Once you see these patterns over and over and over again, it's very easy to execute on them. But the impulse to want to do it the first time you see it because you've watched this video, that is going to be problematic for you. So you're going to have to do
That's where the liquidity comes from.
Number of weeks and months of back testing. There's no escaping that. You have to do it. Any skill set, any teacher, educator, system, whatever, okay, whatever they're going to give you, there's going to be some kind of growing period where you have to trial and error, fix the problems that you have about yourself. And I've literally taken your attention to a very specific framework and setup. Notice that? Some of you may think I'm still talking too much, but I'm taking you right into the heart of the matter. This is what it looks like. This is
You talk too much sometimes, but you give value, so I don't care.
Looking for, okay? These are the fingerprints of that setup. These repeat. So if you know what they are and what those components are that make up this setup, you'll be able to find them. But focus on the imbalance after the market structure breaks. So this big candle here, it breaks down. Look at the next candle. It opens and trades higher and stops.
Market structure shift, not market structure break. Market structure break comes from higher time frames.
There. So from this candle's low and this candle's high, when this candle starts trading, as soon as it opens and it runs right up into that, that's a short. You can go right in there and sell short. Be done. Now, where's your stop going to be? Well,
right above the high.
You can put it above this high here, or you can put it above this candle's high. Whichever your risk parameters allow for, okay? If you're trading the micro, which is, again, it's not a lot of money per tick, so the multiplier for that is very, very small. If you trade the larger full futures contract, and if it moves 100 points, and they can do it real quick, it can burn you pretty bad. So you may have the leverage to trade with a discount broker. Okay, you may have the initial margin to trade with a discount broker, but you may not have the wherewithal and the skill set to navigate this market. And that's the only thing I'm trying to provide here as an alternative, because there's a lot of individuals out there that will promote the idea that you can go out there with a discount broker and just clean up. Look at the logic in here. And I want you to think about after this forms and you see that as your choice setup or entry. If it starts to move lower, you can still get in it. There's no reason not to think that you can't get in it here or in here.
Exactly.
It's close to or in close proximity to where that area is as an entry. Once we take out a low, though, once that occurs, then it becomes a matter of your chasing price. And if you try to get in, especially if you use a market order, you may see it trade right to this low and say, okay, now I believe it's going to go down. You put a market order and sell short, and then slippage gets you down here.
Yep.
And it creates a large area of risk that you have to assume. It's problematic. You want to learn to trust going short when the market's going higher, and that feels scary at first. But once you start seeing this pattern form, it becomes easy to trust it. And in fact, you want to be doing that. You want to be selling short, expecting lower prices, right when the candle's going up. And retail traders can't grasp that many times. It's just like, it goes against the logic because they think, I got to have confirmation. All the books say I have to have confirmation. And that's somebody that's coming in late. That's someone that doesn't know how to read price. They can't really follow it. And usually they're the people that will trade short with additional sell stops. They'll put sell stops below the marketplace, and then that's the momentum entry for them. And it's kind of like a no-brainer. In fast markets, it works. But if you don't know what you're doing and you try to do that in a market that's consolidating or about to reverse, it hands you your backside. Okay, so if you're looking at this framework here, and we've taken the buy stops, we have our entry pattern here, what would you be looking for as a downside objective? Well, I'm going to teach you
Right here.
the liquidity matrix. Okay, and sounds pretty cool, sounds neat and all that, but watch what it is.
When I first watched this, I was like, whoa, liquidity matrix. Is he talking about premium and discount? Let me see.
This here is your range. This is the low of the day, and this is the high of the day, thus far. So if we take that range and split it from the low to the high to get the midpoint, all of this can be determined by a simple 50 level on a Fibonacci. So you drag your fib from this high down to that low or vice versa, and have your 50 level highlighted. Then anything above that 50 level, this is referred to from an algorithmic stance as a premium market. It means it's expensive. Now, markets can stay in a premium for a while and not go to a discount, which would be below the 50 point.
We've seen that this year,
50%.
haven't we?
Anything down here is a discount. If you're bearish, if you're ever going short, you want to look at the previous range. Where are you at inside that range? So when this formed here, that little fair value gap, once that formed, you're thinking, okay, we are in a premium, so algorithms will want to go to a discount. That's the opposed.
This right here, once again, another very powerful message in, the very first episode. I wish I learned this right off the bat in the private mentorship, but, everything was kind of like scattered around like a little puzzle. But very powerful but simple technique here. You're simply just entering at a reasonable spot in the premium and exiting at the discounted rate, such as the internal sell-side liquidity here and the discount imbalance. So very powerful.
Side of the marketplace. So if it's going short here, it's driving the market lower. What does that mean? The algorithm is going to start pricing lower. You can have all the buyers in the world come in. If the algorithm is in a sell program and it's going lower, it does not matter. It's going to reprice lower and lower and lower. And then what will happen is those buyers that may come in with a huge influx of volume, they're going to get crushed and they get squeezed. You ever hear that term, oh, this is a bear squeeze, this is a bull squeeze?
Pat.
All that is an excuse for them not to know why the algorithm's doing what it's doing. That's it. That's all it is. It's an out. Okay? I'm telling you, this is what's really going on. So the market's moving from this premium high, this specific entry point, to a level below the 50 of this range, this low and this high. Now, I want you to, again, go back and rewind the video once we're done and look at that execution page where I showed you my entries.
Yes,
going back
we saw.
up and down, and where I got out at, where I got in at, okay? I want you to think about what below this level here, the 50 level, what is resting below here?
Sell stops.
Sell stops. So now think about the idea of someone like you and I that would see this ideal entry as a short. We have to sell to get in that short. How do we get out of that short? We got to buy it back or cover it by buying. Well, we're going to find willing sellers at a low price relative to this point here. They're willing, already sitting down there with their sell stops right below that low. Now, look closely. What else resides right near that low? Do you see it?
I
Pause
do.
the video before I show it to you because it kind of ruins the experience. Because if you find it and I don't tell it, it feels good.
First time watching it, yes. I was like, oh yeah, that imbalance right there, yeah.
Right there is that imbalance I mentioned. Okay, it's only one single candle passing up, and the previous candle's high and the next candle's low. That area right there is an imbalance. From this area here, it went down below the 50 level and attacked these sell stops and completely closed in this imbalance. So every point of this candle's high to this candle's low, that range with the candle only going up, that's a buy side imbalance.
Sell side inefficiency.
It has to have an equal delivery to be efficiently priced and booked by the algorithm. It goes down and completely closes it back in with down movement. Notice the candle on this here, it opens and then trades down. So it fulfills its role of balancing the buy side offering, now the sell side offering.
Whoa,
So
did you say balance? No, it's no, you told me. This is redelivery, not rebalance.
Is an efficiently delivered price move. Precision elements from the entry here down to here. Everything else after that for the rest of the day, I didn't care about. Even though I had an objective of that old daily low, I wasn't expecting it to run into this particular day. And that's why I didn't participate anymore the rest of the day. In hindsight, I wish I would have left a small position on and just let it go.
We've all been there.
But
yep.
You're going to have that. You're never going to be right about everything all the time, every single day. You're going to leave things on the table. You're going to get in too early. You're going to hold too long. You're not going to buy enough. Or you're not going to sell enough. There's always going to be some reasons why you didn't do something right. So don't beat yourself up about it, okay? But if you can find elements like this repeating in the price action, can you agree with me that that is amazing precision? And this is the logic I used to do that trade. The very trade that I showed you that was the largest one in the example of saying which one would you rather learn how to do. I basically just handed you an ATM machine, okay?
If you
this repeats
know what you're doing, yes,
every
you did.
single week. Every single week.
Every single
now,
day.
I want you to count the number of the handles in this move. Let's say you got in at, say you got in at 800.
Okay, guys, this will conclude my reaction of the very first episode of the 2022 ICT Mentorship. I hope you enjoyed this. If you did, hit the like button, and yeah, see you guys in the next one.